Hello everyone, welcome to my second presentation, which is based on pace trading using stochastic control based approaches, where we consider the OU model as the underlying model to model the spread between the two assets. So in this presentation, we will not go too deeply into the stochastic control theory and the corresponding derivations, as that is not the focus of this presentation. I'll mainly try to focus on how stochastic control approaches can be used for pace trading and look at the corresponding results. So firstly, let me introduce myself. So my name is Vijay Nadimpalli, and I'm currently working as a quantitative researcher at Hudson and Thames. I'll be joining the Masters in Computational Finance program at Carnegie Mellon University this coming fall. So let's look at the contents of this presentation. So firstly, I'll be introducing the two papers that we'll be discussing here. These papers had the highest impact in this particular domain. So firstly, I'll look at how an OE process can model the spread between the two assets. And then we'll go deep into the two models and we'll look at the corresponding results from the two models as well. So firstly, let me introduce pace trading. So pace trading is a type of trading where we try to exploit market inefficiencies. So let's assume we have a couple of stocks that move closely together. For example, we could consider the case of the same stock trading in different exchanges. In the ideal world, the price of this stock in both these exchanges will be similar for obvious reasons. But our world is far from ideal. So due to the inherent frictions in the market, there may be a significant divergence in the price for periods of time. Arbitrage or people who try to exploit differences in prices, they can earn profits by exploiting this market inefficiency using pace trading methods. So let me introduce the two papers that we'll be discussing here. So the first paper is titled Optimal Pace Trading, a stochastic control approach, written by Muchner-Tonsak, Prims and Wong in 2008. And the second paper is titled Dynamic Portfolio Selection Arbitrage, written by Urek and Yang in 2007. So firstly, let me introduce an OU process. So an OU process is a stochastic process, which is both mean reverting and stationary. And an OU process is modeled using this stochastic equation, where we have three parameters to consider. So the first parameter is the rate of mean reversion. And it denotes how quickly the process returns to its long-term mean. And it can also be represented by the half-life of the process. And the second parameter is the theta parameter, which is the long-term mean of the process. And sigma is the standard deviation of the process. And the figure to the right-hand side is a simulated OU process for 500 days. And as you can see, it is mean reverting. So next, let's get into the first model, the Muchner-Tonsak model. So in this model, the main aim is we try to model the log relationship between a pair of stock prices as an OU process and use this to formulate a portfolio optimization problem, which is based on stochastic control theory. And the optimal solution to this a control problem can be found in closed form via the corresponding HJB equation, also called the Hamilton, Jacobi, and Bellman equation. And this equation can be solved to get a PD, a partial differential equation. And that partial differential equation can be further simplified and we can solve for it analytically and get the optimal portfolio weights. And for the parameters of the model, parameters of the OU model, the three parameters that we have seen before, these parameters can be calculated using maximum likelihood estimation. So next, let's look at how we can construct the portfolio, which will contain the spread. And this portfolio contains, as I said, the spread between the two assets and a risk-free asset. So one thing to note here is we assume that the two stocks can be denoted as stock A and stock B. And we assume that one of the asset prices, that is either stock A or stock B, follows a geometric Brownian motion. And the equation is equation to represent the geometric Brownian motion is given here. And to the right-hand side, we can see the formula that could be used to construct the spread between the two assets. The spread is constructed by calculating the difference in the log prices of the two assets, asset A and asset B. And this spread between the two assets, XT, is modeled using an OU process, as we have seen before. So next, after we have calculated the wealth of the portfolio, or we have calculated the equation that can be used to generate the wealth of the portfolio, Next, we can look at how the total wealth of a portfolio moves through time. Here, let's assume that H of t and H tilde of t, they denote the portfolio weights for stock A and stock B. And using that assumption, we are able to calculate the wealth dynamics of the portfolio using this equation, where V of t is the wealth of a portfolio at time small t. And H of t, as I mentioned before, is a portfolio weight corresponding to stock A, and H tilde of t is a portfolio weight corresponding to stock B. And a critical assumption we make here is that we assume a delta neutrality condition or constraint. That is, we go long in one stock and short in another with equal dollar amount. That is, it basically means H of t is equal to H tilde of t. So this simplifies our problem, and now we only need to calculate H of t for each time small t. So basically our objective is to calculate the portfolio weights for the spread asset, that is H of t, which would maximize the expected value of the invested utility function at the end of the investment period, that is a time capital T. And for this, to do this, firstly, we need to consider a utility function for which represents our investor. And in this case, in this paper, the authors assumed the power utility under terminal wealth as our investor utility function, where gamma is supposed to be less than 1. And the final equation here gives us the power utility function. And the gamma parameter present here, basically it represents the risk aversion of an investor. So what I mean by this is, the smaller the value of gamma, the higher the risk aversion properties of that investor is. So after we have looked at the power utility function, or the utility function which is used to model the investor preferences, next we can look at forming the optimization problem. And our objective is, as I mentioned, is to maximize the expected utility of the investor utility function at final time capital T. And this is the final automation problem that we'll be obtaining from these constraints. So we have these constraints to consider. So these are the initial values, B0 and X0. And these two equations give us the dynamics of both the spread and the wealth of a portfolio. So from this optimization problem, as I've already mentioned before, we are able to get the HJB equation, and from the HJB equation, we get a PDE, and that PDE can be analytically solved to finally get the final optimal weights, which are given in the below equation here. And the plot on the right-hand side is a plot calculated for, I think, the GLD and GDX pricing data from 2018 Jan to 2020 Jan. And this is the optimal portfolio weights for the spread asset. So next, let's look at the results of this model. It's a pretty simple model comparatively, considering the other stochastic control-based models. So let's look at the results. So firstly, let's look at the code that can be used to generate the results. So the OU model Murchison-Tomczak class is under stochastic control approach submodule inside ArbitrageLab. Consider the data set here is the GLD and GDX daily pricing data from 2009 to 2020, where we considered a 1-year testing period. And obviously, we split this data into a training data set and the testing data set. And the training data set is inputted to the fit method, which calculates the parameters of model, or estimates the parameters of model. And these parameters are given on the right-hand side, where here we have the long-term mean, rate of mean reversion, and so on. The half-life of spread given here can be calculated from the rate of mean reversion of spread. So next, after we've calculated these estimated parameters, next, using the testing data, we can calculate the optimal portfolio weights for the spread asset in this testing region. And we also need to input a parameter, the gamma parameter. So here we have inputted it as -10. And as the gamma parameter, value of gamma parameter decreases, that means that investor is more risk averse. So that's pretty much it for calculating the optimal portfolio weights. And using the calculated optimal portfolio weights, we are able to generate the wealth process as well. So in the next slide, we can see the wealth process that is calculated throughout the testing period. Here, the testing period is from 2018 Jan to 2020 Jan. And our initial wealth is assumed to be 1. And our final wealth is around 1.15. So we have made a decent profit, but there are some drawdowns to consider here. Okay, so that's pretty much it for the Mojo model. Now let's look at the UDEC model, which has some pretty interesting results. So firstly, let me talk about some intuition behind why we use an OU process to model the mispricing between the two assets. So exploiting real-world mispricings, it requires us to think about a combination of both the horizon risk and the divergence risk. So what do I mean by this? So the horizon risk is basically the risk associated with uh, the uncertainty about the time at which mispricing can disappear. Whereas the divergence risk is a risk associated with the phenomenon where the mispricing can actually significantly increase before converging. So an OU process can actually model these two types of risk quite well. So next, let's look at some of the utility functions that are considered in this paper by the authors. So the authors actually considered two utility functions here. So the first one is a CRR utility function, which is defined over wealth at a finite horizon or a finite time period. So here the investor maximizes the discounted utility of terminal wealth using a power utility function. And in the second investor utility function, there's a Epstein-Zinn utility, which is defined over intermediate cash flows or fees. The results actually shown in this presentation, they mainly focus on using the CRR utility investor. But actually the same results can be obtained for the Epstein-Zinn utility function as well by following the implementation that are already present in ArbitrageLab. So what are the reasons for actually considering these utility functions? So our logic is basically driven by the incentives of real-life arbitrage, such as prop trading desks or fund managers with a fixed investment horizon. So in this case, actually using a finite horizon CRR utility function makes sense, as such investors are generally interested in the distribution of the wealth over a finite time period. And in the real world, we also need to consider the role of management fees. So for that reasoning, we use the Epstein-Zinn model, which captures the role of management fees. Actually, it captures a flat management fee, so that's our assumption in this model. So let's move on to building the portfolio. This is the same process that we have seen in the previous model, the Mojo model. So firstly, we assume that, as we have seen before, we assume that portfolio consists of a risk-free asset and a mean reverting spread. So to calculate the spread, so we can see the construction that is shown on the right-hand side. So firstly, we calculate the total return index for each asset in the spread. So we calculate the total return index for the two assets. And after we've done that, we use Engel-Granger co-integration regression to calculate the weights that will finally give us a linear combination of the two return indices. And that is used to consider the spread between the two assets. So here we are not considering the difference in the log prices that we have considered in the Mojo model. So after we've calculated the construction, after we have constructed a spread, one thing to note here is because the value of the spread represents the price of a long short portfolio, buying 1 unit of spread here is equivalent to buying 1 unit of the overvalued security and shorting 1 unit of the undervalued security. So some of the assumptions of a model is that we assume that there are no margin constraints, that is we are free to short, and we exclude the role of any transaction fees, and we assume a frictionless continuous time setting value. So next, let's look at some of the constraints of a portfolio and how we can model these constraints, and further we look at the wealth, how we can model the wealth of a portfolio. So the risk-free asset and the spread between the two assets of a portfolio are modeled by these two equations. So next, after you have modeled them using these two equations, we look at how we can model the wealth of a total portfolio. So, and the wealth is modeled using this particular stochastic equation, where N of T is the amount of money we put into the spread asset at time small t, and M of T is the amount of money we put into the risk-free asset. And here C of T is the consumption fees or the management fees that the investor can take from the total wealth of a portfolio. So finally, we are able to calculate using the wealth process as a budget constraint for our portfolio, and looking at the optimization problem and solving that, we're able to finally calculate the optimal portfolio weights using stochastic control theory. This is a similar process that we have seen that I have mentioned in the previous model, the Mojo model. And the derivation is actually out of scope of this presentation, but interested viewers can refer the UREC 2007 paper for a detailed derivation regarding how we are able to actually calculate this optimal portfolio weights. And this equation gives us optimal portfolio weights, final optimal portfolio weights, which are calculated from the HJB equation. So here, one thing to look at is if gamma equal to 1, this represents the log utility investor. And when gamma is greater than 1, it means that investors are more risk averse. So the bigger the magnitude of gamma is, the more risk averse an investor is. And if gamma is less than 1, it means that investor is more risk tolerant, or he's willing to take more risks. So on the right hand side, we can see a plot of the optimal portfolio weights calculated for the spread asset from 2019 May to 2020 May. This is calculated on the GLD GDX pricing data. So next, let's look at a theory called Stabilization Region, which is a pretty interesting theory, and it gives us some pretty interesting results. So sometimes arbitrage, they need not arbitrage, or they should not arbitrage. What I mean by this. So generally, if there is a sudden increase in mispricing, there will be an added participation by rational investors due to obviously an increase in the investment opportunity set. There is more chance of a profit. So, but there is a level of mispricing beyond which further increase in the mispricing actually reduces investor participation. Sometimes arbitrage do not arbitrage. Although an increase in mispricing, it should ideally provide added participation by rational investors. This effect can be offset by the combination of the loss of wealth and the nearing of the evaluation date. So this reduces the investor's effective risk-bearing capacity. So there is some complex trade-off that exists here between the two effects, that is the increase in the investment opportunity set and the nearing of the evaluation date, and the combination of loss of wealth. So this complex trade-off, it gives us a time-varying boundary, outside of which further increase in the mispricing, it makes rational arbitrage to cut their losses and actually decrease their allocations to the spread, which is a pretty interesting. So we're able to calculate the stabilization region using this particular formula, where we are able to calculate the maximum bound and the minimum bound for each time small t. On the right-hand side, we have the stabilization bounds by including the spread, the two assets for time period between 2019 May to 2020 May. And to reiterate what I've already mentioned, so if the spread is within the stabilization region, so on the right-hand side, you can see the spread is always within the stabilization region. So the spread follows this type of a process. The improvement in investment opportunities from a divergence of spread from a long run mean, that is, if there is a sudden increase in the value of the spread, this divergence, this increase in the investment opportunity set due to this, it outweighs any negative wealth effect, and the arbitrage actually increases position, increases capital N in the mean reverting asset. And this type of trading actually has a stabilizing effect on the value of the spread. But on the other hand, if the spread is outside the stabilization region, the wealth effect dominates. So this leads the arbitrator to curb his position or cut his position despite an improvement in investment opportunities. And in this case, the trading by the arbitrator actually has a destabilizing effect on the value of the spread. So next, let's look at fund flows, which is another pretty interesting pretty interesting result that can be formed from this model. So along with fluctuations of asset prices, fund managers also deal with their clients' desire to increase or decrease their respective funds. Inconveniently, clients are most likely to withdraw funds when the performance of the fund has been poor, or the past performance of the fund has been poor, and due to some sort of widening of a spread. And this is actually the case where investment opportunities are the best. So this is not really ideal for a fund manager to deal with. So in order to understand the effects of fund flows on the model, the authors introduced a fund flows process denoted by capital F, which is shown here. And here capital Pi denotes the past performance of the fund. And we can see that capital F is modeled such that it is directly proportional to the past performance of the fund. And there is another term here which is uncorrelated to the past performance of the fund. So if we look at the correlation between the fund flows, small f, and the realized performance, that is the past performance, capital pi, it reveals some interesting details here. It reveals some intuition behind how this fund flows process is actually modeled, why it is modeled in this way. So if we look at the equation given here, as the value of or magnitude of capital N by capital W increases, the correlation between capital pi and capital F increases, as small f is considered to be positive. So this implies that the correlation between the fund flows and the fund performance increases as the spread diverges from its long-run mean. This basically means that a fund that has experienced losses due to a divergence in the mispricing already is also likely to experience loss in fund flows, or there will be an increase in outflows from client withdrawals. That's not really ideal for the fund manager. So this model actually works quite well in capturing this possibility of a liquidity crunch. And using this model, we're able to calculate the optimal portfolio weights that can be used by the investor or the fund manager when he has to deal with fund flows. So this below equation actually gives us a pretty surprisingly elegant result of the optimal portfolio weights, which is basically a fraction of optimal portfolio weights without fund flows. On the right hand side, we can see a plot of this optimal portfolio weights from 2019 May to 2020. Again, on the same data set I considered before. So finally, let's look at the results that we have obtained from using these models. So firstly, let me talk a bit about the code that can be used to generate these results. So the OU model UREC is under the stochastic control approach submodule inside ArbitrageLab. Here again, we consider the GLD GDX pricing data, and the training data set is inputted to the fit method, and that calculates the parameters of a model. And using these parameters and the testing data, we are actually able to calculate the optimal weights. And we can also calculate the stabilization region and the optimal portfolio weights with fund flows using this testing. So let's look at some of the results that are obtained. Here on the right hand side, we have the wealth process from 2019 May again to period of 1 year. And here initial wealth is assumed to be 1. And you can say that we have generated quite a decent profit. Next, let's look at some of the out-of-sample performance of this trading rules for the Royal Dutch and Shell pair. This pair is data set for this pair is considered from 1990s to 2005, before the merger of these two entities. So to backtest this data set, we take a 10-year backward-looking window to estimate the parameters of the OE process, and use these estimates to trade for the next 250 days. So we have 5 backtests that are going on here with a rolling 10-year backward-looking window to estimate the parameters. And the reason for considering a 10-year window is that's a window that was actually considered in the original paper. So we try to stay true to that data set. But we can actually calculate the parameters using a smaller data set. And the first plot on the right hand side is the optimal portfolio weights without fund flows from 2000 to 2005, and the second plot is with fund flows. As you can see here from the equation that we have seen before, the y-axis is basically a fraction of the previous plot. So next, let's look at evolution of the spread with stabilization bound, again for the same data set. And finally, the final plot is the evolution of the wealth over the lifetime of the simulation from 2000 to 2005, with initial wealth normalized to 1. And here you can see that we have multiplied our initial wealth, so we have done quite well using this model. So that's pretty much it for this particular presentation. So here are the reference papers that are used for this presentation. I would highly recommend going through these papers if you're interested in know more about stochastic control theory, the actual derivation that we use to calculate the optimal portfolio weights. The UREC paper actually has some interesting backtesting results if you'd like to know more. And obviously, please feel free to experiment on the implemented methods in ArbitrageLab to run your own backtests on the datasets. So finally, I'd like to thank you for taking your time out to listen to this presentation. And if you have any further questions, please let me know in the comments.